and welcome to the ET Now ICICI Prudential Value Investing Summit. Well, thank you so much everyone for taking time out and joining in for what is a very unique initiative in order to highlight the importance of value investing. And especially at a time when right now the stock markets are looking at a multi-year bull run. In fact, we have several interesting sessions that are lined up for you today. We also have a Q&A session where people in the audience will be able to ask questions to our esteemed panelists. I'm now delighted to introduce a man who certainly hasn't been afraid of contrarian calls. In fact, his process-oriented approach has been the key in delivering consistent performance. Ladies and gentlemen, please give us a round of applause for ICICI Prudential's Chief Investment Officer, Naren, who is going to share with us all his valuable insights and tips.
All of you. It's been a very interesting experience because in 90s we obviously didn't have an internet, and consequently the amount of information flow on what constituted investing or value investing was very difficult for us in 90s. But over the last 20 years, I would say things have changed so much that possibly anything that people talk about on investing is available on YouTube the same day for us to download in India. And that has certainly helped people like us who wanted to focus on value investing. Because way back in 90s, there was only one person we had heard of, Warren Buffett, and we learnt a lot from him. And but luckily what has happened over the years is Warren Buffett has the advantage of running only closed-ended money, and that too a closed end with there is no end to that. Whereas we run open-ended funds, and consequently we had to expand our theory to actually include a number of people who focused on running open-ended funds. And this process is actually gathered once we saw 2007, 8, 9. This process became an absolute necessity because whatever investing processes that we had, when we saw what happened to the investments in 2007, 8, 9, we realized that there is much more learning of theory for us to actually manage public money in a very good manner in the future. Because sitting in 2007, we didn't know why stock prices were so high. Sitting in 2008, we didn't know why stock prices fell so low. And in 2008, if anyone had known that 2009 would have been so ballistic, people would have invested, but they got such a beautiful return in 2009. So I think the 2007 to 9 experience put us clearly that we needed gurus and to help us guide for the future, particularly when we are managing public money. And one of the first gurus that I found very useful was a person called James Montier. And as this quote says, there are a lot of times you don't know what to do, but you create a portfolio as though you think you know what to do. And he had written a beautiful book on value investing, and in that one particular chapter in which he focuses on 10 tenets of investing, primarily almost everything that needs to be known on investing is very much there in that piece of paper, which is just 10 pages. Value investors say, most of them say they don't look at the top down, they don't look at macroeconomy. But when I looked at the last 5 years, the 2 times when Warren Buffett famously invested were both periods where the top down was at its worst. When Lehman happened, he invested in preference shares of GE and Goldman. And in 2011, he invested in preference shares of Bank of America. And if you looked at both the economic environments which prevailed at that point of time, it was very bad. So while he doesn't look at top down, the top down ensured that the gap between the intrinsic value and the price at which he was buying was so high that he found it extremely worthwhile to come into the press and say, I'm investing. So the way top down is used by the value investors, which I found very interesting, was they actually use top down to determine the best time for the biggest gap between the price and the intrinsic value. As far as being contrarian is concerned, I think very clearly we know every price that is set by buyers and sellers. And if wherever there are too many buyers, the prices go up. And when there are too many sellers, the prices go down. So what happens is, when you know that when you have a situation when there are too many sellers, for you to buy is very easy. And the price is set by the sellers because there are too many sellers, and we have found it to be very useful over a period of time. The third, I think Mohnish has talked about it, and I don't think there's much I can add to it. But on the fourth, which is be unconstrained, what we have seen is that that is very critical, because otherwise what happens is there are times when you have small and mid caps which are very cheap. There are times when debt is very cheap. There are times when global equities are very cheap. There are times when commodity stocks are very cheap. There are times when quality stocks are very cheap. So the more and more you're constrained, what happens in this whole process is that you don't know. As Mohnish pointed out, benchmark is very important. But there are times when you have to go outside the benchmark to get the best investor experience, because at various times, like if you go to 2007, you'll find that all the quality pharmaceutical stocks and quality consumer stocks were very cheap. So if you were unconstrained, it was very easy to buy cheap stocks in 2007. But those cheap stocks in 2007 were in the pharmaceutical and consumer areas, whereas now they are in a different area. And as far as forecasting is concerned, you know our experience. I don't think if we had met 6 months back, we would have known crude would be $58 today as we speak. And you know, almost everyone in the world had a view on crude oil, but I don't think 6 months back there was any clue that crude Brent would be below $60 in 6 months' time. And we have seen it across. If you go back to August 2013, when rupee touched 68 rupees, I don't think to a dollar, I think everyone started giving forecast of 75. And you know, a year later, when other currencies have done badly, rupee is much, much stronger than what it was in August 2013. And in our own experience, we have seen last year when people had done an event in December 2013, for them to forecast in December 2014 that this would be the index and small cap index would give this kind of return was very difficult at this point of time. And one of the lessons that we have learned is to be skeptical. That actually tends to be, some people find it very irritating, but the goal for us when we manage public money is that the more skeptical we are, we try to avoid mistakes. And we can't be cynical, but we have to be skeptical, because what happens is we see data, we do see, sometimes we meet managements. When in many of these things, many statements are made which force us to be skeptical. Because particularly if you go back to 2007, no one realized, anyone who was skeptical actually had a very good experience between 2007 and 9. Whereas most people who were not skeptical in 2007, they had a very good experience in 2007, to be followed by a very, very difficult period post that. So what we have to, and that too we are allocating scarce money, the more skeptical we are and we find the best ideas, it always works. The next point, I would say, the cycles matter. This is something which we have got used to, and in my opinion, most people don't realize these cycles, and these cycles happen across asset classes. At the peak of the cycle, people are extremely bullish on that particular asset class or product, and at the bottom, people are very, very bearish. You know how many people said dollar is gone about 4 or 5 years back or 7 years back, and you know what has happened to dollar in that period. So you know, you periodically go through these cycles, and the reason why fund managers have a job is because they have to navigate these cycles well. And if they navigate these cycles well, there's huge money to be made. I think clearly, if you treat your clients as you would treat yourself, there is huge money to be made, and that's what Montia keeps saying. And history matters. And as we see, you know, today there is a certain history which happens today. For example, crude falls, there's a set of countries in deep trouble. you try to see what happened when the earlier time it happened. So you look at it. And it is history which allows you actually to be invested, because as Warren Buffett keeps saying, when always things have improved. So Montier's model is very easy to practice, and in my opinion, but it involves pain during an event, and particularly during a bubble period, but it has worked. The second guru which I have learned a lot from was Howard Marks. The beauty of Howard Marks is he has written all that he can on his website, free for anyone to read, in a website called oaktreecapital.com. And the second beauty about Howard Marks is that he doesn't use any financial jargon. And in my opinion, if anyone follows what he has written, it is very easy to make money over a long period of time. And he has found it extremely useful. He calls that basically everything is like a pendulum of a clock. There is a point of time when the pendulum is extremely positive, that is one end. And on the other end, it can become extremely pessimistic, which is the other end. And in both these situations, you find that you have to act against it. But there are periods of time when it is in the middle. And when it is in the middle, there is no logic in taking either extreme positive view or an extreme negative view. And you would have seen over the last 10 years, we have seen these cycles operate in all asset markets. It can be fixed income, it can be equities, it can be real estate, it can be foreign exchange. And we have seen these cycles operate over periods of time. There are times when the pendulum is extremely optimistic, and there are times when they are very, very pessimistic. And he says that if you recognize these cycles, you're actually in a very, very good shape. If you're going to buy something very expensive, let's assume you buy the best company in the world at a very, very high price. It is a high-risk investment. Being in distressed assets, what he recognizes this very, very closely, because at times, some of these very, very low-quality investments, they may become very, very cheap. And therefore, actually, they are at low risk. And that's why we have seen, and one of the things which we have seen over a period of time is the way the benchmarks are constructed in most global indices. What happens is the most favored asset class or the most favored sector becomes a very, very big part of the benchmark. So if you go to Japan in 1990, apparently Japan was a very, very, very big part of the global benchmark. And people used to get hurt by being underweight Japan. And similarly, we have seen in India that in 2000, the technology industry had a very, very high proportion of benchmark. In 2007, we had infrastructure, telecom, all these sectors had a very, very high weightage in the benchmark. So somehow, benchmark movements we have found is a very, very good indication of how price results in benchmarked investors taking higher risk. And that's how he says very clearly that if you're able to focus on price and realize that risk is not something dependent, you can buy a consumer company and lose money, you can buy a distressed real estate company and make money, because risk is a function of price. The third thing I think most people don't realize, and this appeals, I would say, even to fund managers, he says there are times when you have to try to make money. Go back last year, if you tried to make money by investing in small cap and mid cap, you actually made a lot of money. Whereas if you go back to the previous year, if you were trying not to lose money and you invested in the safest stocks like consumer or technology or healthcare, you actually managed to avoid losing money. And most of the time, you have to decide whether you're trying to make money or you're trying to not lose money. And as fund managers, our goal is to actually decide where we are in this equation. And the more we are clear on where we are in this equation, we can actually make a very good difference, because in 2007, if you tried not to lose money, you actually made very good benefit for you in 2008. Whereas in 2007, if you tried to make money, you made money in 2007, but lost it in 2008. So somewhere, as wealth managers, as fund managers, as people managing your own money, we have to be clear whether we are trying to make money or we are trying to not lose money. And your portfolio strategy has to be dependent on which one you're actually focused on. I think over a period of time, everyone recognizes investment is common sense. It is very easy because it is common sense, but the problem is for us to control our emotions turns out to be a very, very difficult task. And we have found that to be extremely difficult, particularly when a bubble happens. So if you go back to 2000, to control your emotions to prevent yourself from buying technology was a very difficult task. In 2007, to not buy infra was a very difficult task. It was very commonsensical that the price to earnings of technology stocks like Infosys and Wipro in 2000 was all more than 100. And similar was the case in 2007 in infra. But how do you control your emotions? That's going to be the biggest task for us to make money in the long run. The third person who's actually written quite a few books and is Michael Mauboussin. So there are a lot of interesting insights that we got from Michael Mauboussin. I think the most important insight I got was in 2013 on election. We had done a lot of post-mortem in May 2009 on what we did post the election, pre the election, etc., etc. And we realized that, doing a post-mortem exercise on how we handle the election in our funds was just a post-mortem. What he says is do a pre-mortem, which is that you assume what will happen. So in 2013, what we realized was when we did the pre-mortem, it was very clear that equities was a great asset class at that point of time. And the pre-mortem suggested that we have to make all the efforts that are required at that point of time to get money in equity. And this came with a pre-mortem. Somehow, as most organizations, people focus on doing post-mortem and not pre-mortem. So what happens is people make a mistake. Then after they make the mistake, they try to see what we could have done better. Instead, you can approach saying what are the different options before you, what are the mistakes that can happen, and what happens, what we have seen from our pre-mortem discussions in our department is that they tend to be less emotional, people are less closed, people are more open because you're not discussing a mistake. As Mohnish said, it would be very useful if people could discuss mistakes, but most people are reluctant to discuss mistakes. So a pre-mortem approach helps you to prevent a number of mistakes. Despite the fact that value investing at its heart has hardly changed, you still get to learn a lot of things over the period. Thank you.
I'd like to invite Mr. Mohnish Pabrai back once again on stage, and this is going to be an interesting fireside conversation between him as well as Naren, and we're going to find out what exactly it takes to be a successful value investor, not just globally but back home in India as well. And of course Nikunj is here to moderate that discussion.
Mohnish, I'll take part of a conversation forward now. Now you've pretty much outlined the template which you follow when it comes to value investing. You said that India is a different market. So the rules of value investing, do they differ in India? Because India is a different market, much more regulated, sometimes opaque as well. Promoters run large part of companies here and government owns bulk of the companies.
Well, first of all, the rules of value investing are the same globally. The difference in India is that, so first of all, in 15 plus years, actually more than 20 years in the US markets, I have never lost money to fraud. Right, so outright, I've lost money because of my stupidity, but I've never lost money because of fraud. So it's not been that financials were fake or there was, what I'm looking at the numbers, this is reality is different. In India, you have a little different situation where 2 or 3 things are different. One is large numbers of businesses are family controlled. And so you have governance issues that exists in many of these businesses. You really, quite frankly, outside investors have limited recourse. The second is that I think the ethos of Indian public company managements is improving every day. But I don't think you could make the same blanket statement here that you could make investments and never have a situation where there's fraud. If I were to invest in India and have an Indian portfolio, I really need to be here, because those are one of the first few questions I would have is, are the numbers correct? What is the ethos of management? Do they care about the outside shareholder? Are they going to be fair to the outside shareholder, and those sorts of things?
If I look at the total number of listed stocks on Indian markets, it's about 6,000 plus. We have the oldest exchange in Asia. But if I look at the market capitalization of India's biggest company, which is TCS, 5 lakh crore, I add Google and I add Apple together, that's pretty much the market cap of India.
So yeah, but the opportunity comes because we can, sitting in India, we can look at some of the smaller names. The second is, sitting in India, we also have a idea of history. So if you go back to the 1996 to 2002 phase, we saw one of the long bear markets in India. We saw what corporates did, how they allocated money, what they did in the depth of the bear market. So, you get a fairly good insight. So I think the combination of having history in many cases and the local presence to do research on the larger number of companies makes our job interesting, and we can go lower the capitalization curve.
Best money is made when you buy an idea or catch them young. That's what we say in financial parlances. Is it difficult in India to catch multi-baggers when they are young?
They are to some extent, but not as difficult as, if you see the companies like, as you should have periodic bear phases. So if you don't have bear phases, then would be a problem. But otherwise, if you see last year, there were so many companies which were at prices which you had seen in 2006. 2006 to 13, 0 returns. We picked them up in 13. In 13 to 14, most of the small caps have all doubled. So, it's a question of, I would say, also timing. And people invest in small caps to an extent like a weather. So, they invest in some years. In some years, small cap is a bad word. So, I only request that people invest in small caps each year. Then they can get a much better investor experience.
I'm going to throw some light on the regulated part of Indian market, and that's the tricky part. Some regulated companies, the energy companies, banks, they're great companies. As an investor, how do you view them? Because if someone is seeking for cheap valuations, that's where all the gold mines are.
Yeah, well, our only investments in India are in the regulated space. And one of the reasons I had an interest is I think that India's banking regulatory framework is probably amongst the best in the world. I would say that the Indian regulatory framework with the RBI and such is much more robust and world class. I mean, I think that was one of the reasons it gave me confidence that we are looking at a country which has a very robust regulatory framework, and now with the leadership, it's just absolutely up there. It's wonderful.
Mohnish, coming on value trap, and that I think is the biggest challenge for a value investor. You look at a business, it is looking cheap, but that cheap because of market conditions, because of changing business dynamics, can even get cheaper. So how does one avoid value traps? Well,
so I don't think there are any value traps. I think there are mistakes. Okay. So I don't like to call them value traps. I think if you think a stock is worth 20, it trades at 10 today, and for the next 20 years it trades at 10, that's an investing mistake. That's not a value trap. So, so my take is that you can either have a situation where you're right, or sometimes things work out probabilistically very wrong, or sometimes you were actually wrong to make the investment. So we have to keep in mind the 66% maximum hit rate of being right. This is a business where errors are part of the game, and this is the business where the key is just try to keep the errors down. And if you make an error, if you don't lose capital, you know, the $10 stock that's changed at $10 is much better than $10 going to $2.
Okay, I'm going to open it to the floor now for some questions.
One of the things that investors keep asking all of us, I'm sure, is that, you know, we call something called margin of safety, and then we say that if the price is below the intrinsic value, then it's a great buy. And then they ask the reverse question as to what is the, how do you get to the intrinsic value? So if any one of the wise people sitting can throw light on that in a simple way, by which we can communicate with our clients, it will be very useful.
The classical definition of intrinsic value is the sum of cash you can pull out from now to infinity from that business, and then you discount it by some reasonable interest rate. And of course, very hard for us to go to infinity, very hard for us to go to even 10 years. But there are businesses on which you can put a floor on it, you know, with a high probability that the floor would be along those lines.
So I'm going to close this session. Unfortunately, we are tight on time.